everyone and welcome to this new video. Today we will talk about a critical topic for any startup: how to build a financial model that not only helps you plan your business but also impresses investors. Whether you are pitching to raise funds or managing your growth, having a solid financial model is a must. By the end of this video, you will have a clear roadmap to create a solid financial model for your startup. So let's dive in. Video highlights. In this video, we will explore the essential of building a financial model for your startup. Here is what you will cover. First, what a financial model is and why it is important. Then, key elements of a financial model. Again, a step-by-step guide to building a financial model, common mistakes to avoid, useful tools and resources, and practical example. So, let's start our intro. Section 1. What is a financial model and why it is important? A financial model is a detailed representation of your business financial performance. It includes revenue projection, cost estimates, cash flow analysis, and profit forecast. Why it is important? So, in essential, a financial model is important for 3 reasons. First, planning helps you understand how your business will perform in the future. Fundraising. Investors use it to assess the viability of your business. And last, decision-making guides you in allocating resources effectively. Common uses. A financial model helps forecast cash flow by analyzing past and current financial data to predict future trends. This is vital for ensuring your business can meet its obligations and seize growth opportunities. Additionally, it serves as a tool to evaluate new business opportunities, allowing you to test different scenarios and understand their potential impact on your finance. Finally, a well-prepared model demonstrates to investors that you have a clear and realistic understanding of your business financial trajectory, which can be a decisive factor in securing funding. As an example, a startup preparing for first fundraising round may use a financial model to forecast how a $500,000 investment would impact revenue and profits over the next 3 years. So I would like to talk about key elements of a financial model. First, revenue streams. Identify all potential sources of income and categorize them into primary and secondary streams. This helps in understanding which streams drive the most revenue and which ones support the business indirectly. An example, a service as a service business might have subscription fee and consulting revenues. The streams directly impact the financial model by determining the scalability of the business. For instance, subscription fees provide predictable recurring revenue, while consulting can offer high margin and project-based income to support growth. And then we have the cost structure. Cost can be split in many ways, but in this case, in fixed cost, there's expenses that remain constant regardless of your business level of activity. For instance, office rent or employee salaries. And variable costs, which are costs that fluctuate based on business activity. For example, the cost of raw materials increases with production volume. It is important to include a detailed breakdown, include a specific per unit cost for manufacturing or digital marketing, for example, and cost per click. Understanding these details helps in identifying opportunities for cost optimization, forecasting profitability. For example, by reducing per unit cost production, maybe by negotiating supplier contracts, can significantly enhance the margins. And then we have the CapEx, capital expenditure. They refer to the funds that a business uses to acquire, upgrade or maintain physical assets such as property, building, technology, and equipment. These investments are crucial for scaling operations and ensuring long-term growth. Here's the detailed breakdown. We have growth CapEx. They are investments aimed at increasing the company's production capacity or market reach, such as opening a new facility or launching a new product line. And then we have maintenance CapEx. They are funds used to maintain or repair existing assets to ensure smooth operations, like replacing outdated machinery, for example. I think, a company that invests in high-performance service to support increased user traffic. Impact on financial model. Initial cost. Capital expenditure are typically large, one-time investments that can significantly impact cash flow in the short term. And then we have depreciation and amortization. The costs are spread out over the useful life of the asset, impacting the profit and loss statement through depreciation and amortization expenses. Depreciation regards to tangible asset and amortization to intangible. Cash flow management. CapEx requires careful planning to ensure the business maintains sufficient liquidity while financing those investments. A business can fund CapEx through retained earnings, loans, or equity financing. For example, a startup may use a combination of venture capital and bank loans to purchase high-cost equipment. Some key considerations. To avoid problems while managing CapEx, I have 3 pieces of advice. First, ensure that the expected returns justify the initial investment. Second, align CapEx decisions with the company's strategic goals. And last, monitor the payback period and the return on investment to assess the effectiveness of the expenditure. Now let's talk about the profit and loss statement. Profit and loss statement or income statements provides a summary of your revenues, costs, and profits over a specific period, typically monthly, quarterly, or annually. It helps business assess their operational efficiency and profitability. Key components of the profit and loss accounts are revenue, of course, total income generated from sales or services, and then we have cost of goods sold, direct costs associated with producing goods or services. We have then a gross profit, which is revenues minus COGS, indicating the efficiency of the production. Operating expenses includes salaries, rents, utilities, and other overhead costs. And then the net profit, the bottom line, showing the remaining income after all expenses, taxes, and interest are deducted. The profit and loss is crucial for identifying trends such as increasing expenses or declining revenues, and for making strategic decisions to improve financial performance. Another important statement is the cash flow statement. The cash flow statement is a critical component of financial modeling as it tracks the actual inflow and outflow of cash within your business over a specific period of time. Unlike the profit and loss statement, which focuses on profitability, the cash flow statement focuses on liquidity, ensuring that your business has enough cash to cover its immediate and future obligations. Key sections include operating cash flow. It's the cash generator used in daily operations, such as revenue collection and payment of expenses. For instance, positive cash flow from operations indicates that the company is effectively managing its core activities. And then we have the investing cash flow. It's the cash spent on generated from investments in assets like equipment, property, or financial instrument. For example, purchase of new machinery would be recorded here, as well as the sales of an old one. Financed cash flow is the cash movements related to funding, including loans, equity financing, and dividend payments. A startup raising venture capital will record the inflow in cash in this section. The cash flow statement is essential for understanding the timing and the availability of cash, which helps businesses avoid liquidity crises and plan for future investments. The last one is the balance sheet. The balance sheet provides a snapshot of your business financial position at a specific point in time, detailing assets, liabilities, and equity. It serves as a critical tool for assessing financial health and stability. Key components are assets, that are what the business owns and are divided into current asset, cash, account receivables, inventory, and non-current asset, property, plant, and equipment. Then we have the liabilities. This represents what the business owes, including current liabilities, account payable, short-term loans, and long-term liabilities, mortgages, and bonds. And finally, we have the equity. It's the residual interest in the assets of the business after deducting liabilities. It's often referred to as owner's equity or shareholder's equity. The balance sheet is essential for understanding how well a company can meet its obligations, fund operations, and support growth. For example, firm with high current assets and low current liabilities is better positioned to handle short-term financial challenges. Moreover, tracking changes in equity over time can indicate the success of reinvestment profits or additional funding rounds. So now, I would like to talk and draw a step-by-step guide to building a financial model. Let's start with the assumptions. Define your key metrics: customer acquisition cost, churn rate, and growth rate, for example. If you plan to acquire 1,000 customers at $50 each, your customer acquisition cost is $50,000. Build the revenue projection. Estimate how your revenue will grow over time. Use frameworks like TAM, SAM, and SOM to refine your revenue projection. By the way, the TAM is total addressable market, the overall revenue opportunity available in your market. The SAM is serviceable addressable market, is the portion of TAM that you can realistically target, and the SOM is the serviceable and obtainable market. It's the share of SAM that you expect to capture based on your business model and resources. For example, a subscription box startup could predict revenue by analyzing competitors and historical sales data while using the TAM, SAM, and SOM framework to set achievable goals. Use realistic growth rates based on market research. And then add cost estimates, include operational cost, marketing budgets, and salaries. It's prudent to add a buffer of 10 up to 15% to your estimated cost to account for unexpected expenses or price fluctuation. This ensures that your financial model remains robust even under unforeseen circumstances. Incorporate financial statements, create profit and loss account, cash flow, and balance sheet for at least 3 years. I'd like to talk now about scenario analysis. Scenario analysis is a vital part of financial modeling that allows you to prepare for uncertainties by examining how different conditions impact your business. Here's how to approach it. You have to draw 3 scenarios. The first is the best case. It assumes optimal conditions such as faster than expected customer acquisition or reduced cost due to favorable supplier contracts. For instance, projecting a 20% revenue growth if a new marketing campaign exceeds expectations. Then draw a worst-case scenario. This explores the impact of adverse conditions like higher churn rates or unexpected increases in operational costs. For example, analyzing how a 10% drop in monthly sales affect cash flow and liquidity. And then you can draw a normal case scenario. This represents the most likely outcome based on your current trends and realistic assumptions. It serves as the foundation for decision-making and includes moderate growth rates and expenses. How to implement? You can use a spreadsheet to model each scenario with separate sheets or tabs. Incorporate sensitivity analysis to test the impact of key variables such as price changes or customer acquisition costs. And then visualize outcomes with graphs to compare how each scenario affects profitability, cash flow, and other metrics. By conducting throughout scenario analysis, you can identify risk early and develop strategies to mitigate them ensuring your business remains resilient under varying conditions. An example of sensibility analysis is: how does a 10% increase in customer churn rates affect your cash flow? So let's talk about common mistakes to avoid. First, unrealistic assumptions. Avoid overestimating revenue or underestimating cost. Validate projections by comparing them to industry benchmarks. Ignoring cash flow. Profitability doesn't mean you have enough cash to operate. Overcomplicating the model. Keep it simple and focused on key metrics. Pay attention that the more complex is a financial model, the less useful it could be. A complex model can confuse shareholders and obscure critical insight, or reducing its overall effectiveness. Simplicity ensures that the model is easy to interpret and update, making it a more practical tool for decision-making and communication with investors. Another mistake is lack of validation. Always test your assumptions with market data and expert feedback. Again, neglecting updates. Regularly update your model to reflect changing conditions. For example, adjust for inflation or unexpected expenses as they arise, and now useful tools and resources. To make the process easier, consider using these tools. Excel or Google Sheets, flexible and widely used for financial modeling. Use built-in, for example, functions like vertical lookup or pivot table for better data organization. Dedicated software. Tools like LivePlan or Projection Hub offer templates and automation. There are as well online resources. Check out for platforms like CFI or HubSpot. And last but not least, professional help. Consult a financial advisor for complex models. Now I want to show you a practical example. Let's now build a simple financial model for hypothetical e-commerce startup. Our assumptions are a monthly website visitors of 10,000, a conversion rate of 5%, and an average order value of $50. So to draw the revenue projection is quite straightforward. You just multiply 10,000 visitors times 5% times $50 each, and we have a monthly revenues of $25,000. And now costs. We have marketing cost of $5,000, a website hosting of $500, and salaries of $10,000. Our profits are $25,000 less costs, $15,500, are $9,500 of profit. And now we draw cash flow. If you suppose that monthly revenues of $25,000 are collected on a 30-day cycle, our cash inflow equals $25,000, and the cash outflow is $5,000 for marketing, $500 for website hosting, and $10,000 for salaries. So our operating cash flow is $25,000 less $15,500 equal $9,500 is a positive cash flow. And now the investing activities. Let's assume that the startup invests $2,000 in new website features to enhance users' experience. This is recorded as an outflow in investing activities, resulting in a net cash of $9,500 less $2,000, $7,500. And then financing activities. If the startup gets $20,000 in equity funding, this cash inflows boosts liquidity, of course. And additionally, if the startup repays $500 for a loan principal, it reduces the cash, and then we have a finance cash flow for investing activities of $19,500. So, as a conclusion, that's how you create a financial model for your startup. Remember, a solid financial model isn't just a tool for planning, it's your ticket to gaining investors' trust and making informed business decisions. We have reached the end of this topic. If you found it video helpful, don't forget to like, subscribe and share it with others. Let me know your thoughts or questions in the comments below. See you in the next video.